Education Thursday. I'm passing Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Scott Hazlett. Scott is a California attorney and CPA who practices in the areas of taxation, real estate planning, financial problem resolution, and 1031 exchanges. He's a certified specialist in taxation law, California State Board of Legal Specialization, and he's also a qualified intermediary for tax-deferred exchanges. Scott previously worked with Price Waterhouse and was an investment executive with Merrill Lynch. He graduated from Taft University School of Law in 1996 and set up his own law firm. He's a past president of the East Bay chapter of California Society of CPAs. And in a past life, he was a sports writer covering Major League Baseball, National Football League, and other sports. So, had some interesting times there, I'm sure. Today, Scott and I are going to talk about the net investment income tax, also known as the Medicare tax or the Obamacare tax.
Yeah, the people with a little more jaded view of things call it the Obama tax.
Yeah, so. I suppose. Anyway, it first became effective in 2013. And we're going to especially focus on how qualifying as a real estate professional can help real estate investors reduce or avoid the net investment income tax. And in getting started with this, I've taken the tiger by the tail and taking on this. This is actually a huge area. And so we're only going to be able to hit some highlights. But we want you to be aware that this area is here and that you should, if it applies to you, be consulting with a competent tax advisor. Now, related to this also, I mentioned I've got a new edition of my book coming out. This is not it. It'll have to be in the printer. It'll probably be coming out by the end of the year. It's the Real Estate Tax Handbook. And this is part of what I discuss in this book. So if you're looking for another reference to have on hand, you might want to pick up a copy of this book. It'll also be at Amazon, and it'll be a Kindle book and all the other good stuff. And Scott's had a chance to actually.
Yeah, I've read the last edition. I've read some of the excerpts of the upcoming edition, and I can testify to its thoroughness and accuracy and so forth, and a lot of difficult topics. So you tackle them well.
Yeah, thank you for that. Scott, why was the net investment income tax enacted?
Pretty good question. I think mostly because the government wanted to raise revenue.
Okay.
All right. So here's the philosophy on in general. When we go to work every day, whether we're self-employed or we work for a company, we get either a W-2 or we get self-employment income. And that type of income is called earned income.
Right.
And earned income not only bears income tax, but it also bears these additional taxes. One component is, we call it FICA, or Old Age Survivor Disability Income Benefits. And the second piece of it is the Medicare tax. So when you go to work and you earn $10,000 in your job during the year, you pay 1.45% of that, and that's withheld from your wages, and that's paid to the government, so it's supporting the Medicare program that supports seniors and so forth.
Right.
Your employer, by the way, matches that, so it's 2.9%. So in the backdrop of the changes in the medical care landscape under Obamacare, it was perceived that rich people with dividend income, interest income, and certain other types of, let's call it, for lack of a better word, non-active income, unearned income, shall we say, that income should also bear its fair share of the Medicare tax burden. So to that end, as part of Obamacare, we got this thing called Section 1411. It was a new code section, and it says that above certain thresholds, which are laid out right in that code, above certain thresholds, that unearned income, interest, dividends, royalties, and gains from these activities are subject to a tax which is 3.8% of the relevant income in question, and it's over and above any income tax that might apply as well. So it's a new tax. Doesn't replace anything, and it's not in lieu of. It is a new tax on top of the.
Yeah. Some people call it a surtax. So, but the idea is it's a separate tax from the other income tax.
Correct.
Even though it's reported on the same part of the same
Yeah.
package.
So just as an aside, so how it gets reported, every individual who has this tax. Let's go through a real quick example. So if I'm a self-employed accountant, let's say, and I file a Schedule C for my proprietorship, and I make $100,000, let's say, and let's say my Medicare tax is 1.45%, but it's actually double because I'm both the employer and the employee.
Right.
That tax is paid and administered through my Form 1040.
Mm-hmm.
So in addition to my income tax that I pay on my Form 1040, I also pay this so-called self-employment tax. Now this is another tax, this 1411 tax, or NIIT. That's administered, so now there's another line on page 2 of your 1040 that says how much net investment income tax do you owe as well, which is computed through this code and so forth.
Right. So this was enacted back in 2010, didn't become effective until 2013.
Right.
As a practitioner, how was the guidance that came from the IRS?
Yeah, so the code was real clear. However, the code left a lot to be desired as a definition of words. We base all these things on words. Mm-hmm. There shall be a tax. It shall be on income. Well, what does income mean? There's et cetera, et cetera, et cetera. You go down the line. So what is the income, the trigger on which this tax applies? It's the investment income. Well, what is that? And so forth. So the thing we're going to talk about today primarily is, what about rental properties? What about activities that yield really what amounts to income from capital rather than income from our personal services?
Right.
And is that an income that triggers this tax?
Right. So part of what I was trying to get at is the IRS didn't even issue the final regulations until November
that's true.
of 2013. Okay. So
yeah, just as an aside, we had our
2000. Yeah.
We had our accountants annual real estate conference last fall, which was in 2013.
Right.
And the guy who was tabbed to give the speech about this kept saying they haven't issued the instructions to the form yet.
Right. And they didn't issue them until well into tax season.
Correct.
So we had probably more extensions this year because of that. Although I think part of what I'm gathering, my sense of it is everybody's relying on their tax preparation software and they're hoping and praying that it's coming out right.
Correct.
Okay. When are the regulations actually effective?
They start the day they were issued, which I don't know that.
Well, actually, 2014. So they're
yeah.
really not effective until this year. You can apply them for 2013, and most of us probably are because we don't know what else to do.
Yeah. So we do have the instructions that did come out and so forth, and I think the instructions for the form itself. What's the form? 8960 or something like that. And the instructions were, 40 pages, I believe?
Something like that.
That's just the instructions. And they were largely based on the regs. Mm-hmm. So if you have insomnia, pull out instructions for Form 8960 and then go through. We'll put you right to sleep.
Yeah, okay. So is everybody subject to this tax?
Well, again, there's a threshold. So the code section, depending if you're married or filing jointly with a spouse and these types of things, had a household, there's a threshold. And only if you reach the threshold, and I don't have the numbers in front of me, but I think it's 250 for married and 200 for single, I believe. Mm-hmm. That's on your adjusted gross income, or really what amounts to adjusted gross income, which is the last line on page 1 of Form 1040. Or the amount of the income, whichever is less. Okay,
The net investment income.
yeah, so the net investment income. So you may have dividend and interest income, but if your AGI, if your adjusted gross income is less than that threshold, you won't be subject to this tax. It's really only intended for those perceived to be the wealthy that have somehow escaped this tax.
And what about estates and trusts? Are they affected by this?
The states and trusts, the limits are much lower, so all of the great estate tax planning which is different than income tax, all that great estate tax planning might have been, that might have been damaged severely, because the estates and trusts typically have income from interest, dividends,
That's mostly
royalties.
what their income is.
Yeah, and they don't really have earned income, and so at the lower limits, a lot of the income from the trust might be subject to this. So this actually might encourage us to go back to our estate planners and see how we can change or look at the investments that our trusts have.
Right. So the threshold for estates and trusts is only $12,150
$11
for 2014. So that's not very much, and there is some planning that you can do. There's some distribution planning that can carry the income out so it's taxed to the beneficiaries instead of the trust.
Correct.
But that can have an impact on different beneficiaries. So you have conflicts of interest all over the place with this stuff.
I would agree.
It's a real problem. So anyway, I just want to point that out. So how does the tax work?
Well, basically, you have you have these two figures you have to work off of: the AGI, the amount above the AGI of your income, and then the net investment income, and whatever the lower is, you multiply that number by 3.8%, and that's the tax.
Right. So
And there's the IRS has a form for that, and it's a deceptively simple looking one-page form.
One-page form with 40 pages of instructions.
However, some of the lines have a lot of implications.
Yes.
And we've said here that this is a tax on net income, and so that means you start out with a gross income concept and deduct something from it, and the something is where we get the 40 pages.
Okay. And so, what we wanted to point out is that you could be talking about actually a pretty small amount. You may have somebody that has over $250,000 of income, but maybe they've got, $1,000 of net investment income, and now they've got a $38 tax.
Correct.
It may cost you a lot more than the tax to have somebody figure out what it is.
Just to compute it. And in fact, I would suggest that the 40 pages of rules, in some cases, the 40 pages of rules might allow you to reduce that tax from $38 to say $17, but it's going to cost you $500 with your accountant to get there. So we just blow it off and go for the cheapest path of least resistance.
There you go. What is net investment income?
Well, it's rents, royalties, dividends, interest, and then gains from those activities. Is unearned income essentially, with some exceptions. And we said net because deductions that are applicable to it are reducing the gross. So, for example, if you've got a rental house, for example, you collect gross rents of $30,000, but you've got depreciation, you've got insurance, you've got taxes, and so forth. Those will reduce the amount of net to reach a net figure.
Okay. So one of the things that's a real key item that we're going to talk about maybe a little more detail is passive activities.
Yes.
So if you have particularly from rental properties, because if you have a trade or business and it's subject to self-employment tax, it's not going to be investment income even though it's passive.
Yeah, right, and that goes back to the philosophy. The idea of the law is that all this income is passed tax-free for all these years, but if it's already being taxed at one level, earned income, then it should be logical that it wouldn't be taxed twice from a different angle.
Yeah. Another thing that I want to highlight for a moment, it has to do with the gains. So, for example, one thing that a lot of people were worried about, and I guess in California, they should be worried about it, it has to do with the gain from the sale of a residence.
Correct.
And so in the Bay Area here, we have homes that are selling for, $1.5 million, $3 million that these people may have acquired for 750,000 or something.
Right.
And suddenly they're way over the 500,000. Is that going to be subject to net investment
Yes,
income
yes.
tax?
So the computation is you take out the exclusion, which is fine, of the $500,000 for a married couple, but you still may have some gain, and of course, the rollover rule doesn't account anymore, so you're just stuck with that gain, and that gain is of a character that would be subject to this tax potentially.
Okay.
So it's just one more thing on top of it.
Okay, so time is going quickly. Let's very quickly, though, maybe hit a few planning suggestions on how to avoid the tax or reduce the tax.
Well, one of the things that we have in our notes here today is to talk about the investment real estate, and we probably should touch on that before we run out of time.
Okay, well, why don't you go ahead and talk about investment real estate. Folks, read my book or whatever. I've got some of these planning suggestions in there. One I'll throw out, though, related to the sale of a residence, because I was just talking to one of my clients about this, I think it was this morning, and that is an installment sale. Can be very helpful, because what you do is you spread the income over a period of time and possibly keep it under that $250,000 threshold.
Right, so that's a matter of seller financing.
Yes, yes.
That's a possibility.
Okay, so let's talk a little bit about rental real estate, and particularly then maybe start to drift into this area of the real estate profession.
Yeah, so let's talk about the 469 rules. That's the passive activities. Okay. So there's this idea before 1986 that we bought a rental realty, commercial, residential, whatever. We wrote it off, and there'd be losses from this thing. A lot of times it's depreciation or highly leveraged and so forth and so on. We'd be making a bunch of money on page one from our day job, doctor, lawyer, plumber, whatever, and we would take this loss and we'd just simply match it. Then Congress came out with this rule in '86 that says basically, with some exceptions, which we don't need to mention necessarily, but with some exceptions, you can't do that anymore. Those losses are going to be suspended until the time you sell the property. And the idea was they didn't want to really have a tax incentive to buy investments. They wanted an investment incentive. That's kind of the idea. So then in '93, the real estate agents got all upset, and they said, look, real estate is the only business in America where you can lose money and you don't get a tax deduction. So how come we can't get a tax deduction? So Congress devised a rule that says if you are a so-called real estate professional, which is a broker, a developer, a lender, and these types of things, so anything to do with a trade or business of real estate, that you can write off your losses with respect to your rental activity. So I can be a real estate agent, and if I work half the time in real estate and at least 750 hours in my real estate business, and I have a couple rentals on the side that I manage and I'm involved with materially is what the rules say. Then, and those things have losses, then I can write those off against my wife's income as a medical doctor, for example,
Yeah.
which goes back to the old pre-86 rules. So that's all fine, well, and good, and that we can go on and we can have two programs on that because there's a lot of complicated stuff. Now, how does that tie into the net investment income rule? Originally, when the net investment income tax rule, this so-called 1411 or Obama tax came in, the idea was that if you had net rental income from these properties, which some people do, they've paid off the loans, they've had them for a long time,
Right.
that somehow these things would be subject to this additional 3.8%.
Right.
Then they came out with a rule that says, but if they're a trade or business, and the realtors all said, hey, this is part of my overall trade or business, so I shouldn't be subject to that. So it's really a kind of magical place. It's not earned income that would trigger FICA, but it's not a passive income that would trigger this thing. So we want to be in this magical place. So it's finally settled in, after all these regs have been issued and so forth, it's finally settled in that if you're in this magical place and you're a real estate professional and you have positive income from these things and you otherwise would fit the criteria to get triggered with this tax, that those things are not considered net investment income. So the planning opportunity, if you will, is let's try to get to this magical place. If that tax is important, let's try to get to this magical place, have these activities that are generating income, They're better than getting dividends. They're better than getting wages because all those things are subject to this extra tax. Now I'm in this sort of happy medium spot that's shielded effectively from this tax, and that's kind of the idea.
Yeah. So, as we said, we've got two basic requirements. You have to spend more than half of your time on the real estate business. It has to be more than 750 hours in real estate businesses.
Yeah, correct.
And then we have to have more than 500 hours in order to materially participate for the properties themselves.
Correct. Or there's other tests, but that's the principal test.
That's the principal test.
Right.
And I can tell you that's what the courts are looking at because I'm looking at case after case that people are going in flames on this stuff.
Correct.
All right. So
So at this point, you bring up a good point. If I can digress a bit.
Yeah.
So if you've got, let's say you've got a fourplex, and you're a busy real estate agent, and you got a business, and you got this fourplex, probably not going to have 500 hours worth of time spent on that. So it's going to. So not only do you have to qualify individually as a real estate professional, but your activity has to qualify as this materially participating activity. So now the question comes: what happens if you had about 7 of them? Which a lot of people do.
Yeah.
So there's an election that you can make
Right.
to aggregate all of these activities. So if you spend 80 hours on 8 of them, that's 640 hours, obviously exceeding the 500-hour rule. And you've just aggregated all these things into a place where now you can, if you have losses on them, you can write off the losses. If you have net income on them, you're not subject to the net investment income tax, the 1411 tax. So that's the key to it.
Right. Okay. Yeah. So it's very helpful. In fact, and there are some, I guess you could say, catch-up elections that are available if you've missed this election in the past, and you have to be able to produce the election.
Correct.
So if you made it in a back tax return, keep the copy of the election someplace so you can show it to an IRS agent.
That's correct.
All right. Isn't it hard to do this when you have another full-time job?
Absolutely. I've got a really great war story that I hope I can squeeze in here. So a guy came in it was getting audited by the IRS, and he came in and he had 11 rental properties, and he had a day job, and he lived in Solano County, and his day job was in San Francisco. And I figured the commute was at least an hour each way, and he had these properties, and I quizzed him on his day job. He was a janitor, or he was some kind of a administrative person or something. So his day job really was 10 hours a day. And when you factor in all the things, the commute and then the time and so forth. So the rule is you have to have half your time,
More than half, yeah.
or more than, well, at least 10 minutes more, than in these rentals. So I worked it out. So he had to have Monday to Friday without fail. He had to have 4 hours each day. And then each weekend day, without fail, with no days off, he had to have 11 hours each weekend day. And so in the punchline of the story is, so I asked him, and I pointed this out, I said, do you work 4 hours each day, and do you work 11? Yes, I do. Yes, I do. I said, well, do you have a marriage? Is your marriage in trouble?
Yeah.
Because he's got so much. Well, obviously he wasn't doing that.
Yeah.
Because it didn't make any sense, nor could he have spent that much time.
Yeah. So what I can tell you, folks, is that case after case, the IRS has a special project basically looking at this issue because it's really has related to losses in the past. Now it's going to be, we're going to double the caseload because now we're going to have income properties as well. And anyway, people are coming in with documentation, and the judge is saying, I don't believe you.
Yeah, you need it. That's right. And you need a diary. You need some kind of contemporaneous thing, not something made up after the fact. The one planning point I will mention is that for a married couple, it's either spouse. So
Right.
I mean, just to be a little sexist here. So the husband has stayed home, and the wife has been in the workforce forever. And the kids graduate from high school and they're out, and now he's sort of free to do. So he joins XYZ Real Estate Brokerage as a full-time real estate agent, and they have all these rental properties. And so through his activities, both of them qualify. So that could be a planning opportunity in some situations.
Right. So we just have about 3 minutes left. I'll just say, this sounds like this is not a slam dunk.
Correct. I would agree. Um, and the interesting thing about this is, well, a couple things. First off, if you're a California taxpayer, this rule does not apply.
Well, for on your California income tax return.
Yeah,
So now you got two ways that you got to account for
so
these
so you claim to be a real estate professional for federal. You have a bunch of losses that you can wipe out some income, but you're going to have an adjustment in your state return. And the other thing is, these losses are not lost. The intention of the law really is to accumulate the losses and have them trigger at the time you get rid of the property. And here's the funny part. If you make that aggregation election, we talked about those 8 properties being one,
Yes.
you will not necessarily get to trigger all those losses, because all of those, you sell 1 out of the 8, you haven't sold in
The whole
what's
thing.
called the full disposition. You still have most of the activity.
Right.
So you have to be very careful about the election, which is of course irrevocable
Right.
going forward.
Right. Well, we only have maybe a couple minutes left. Maybe you can just sort of sum up or throw out, some final ideas related to this area.
On real estate, people come to me for real estate tax advice all the time, and I'm constantly getting back to the economics. Why do we own a property? Is it really good? Should you be owning a property? And you shouldn't let all these tax rules drive your decision making all the time. I mean, I'm sure you hear this too. Well, gosh, I'm supposed to make a bunch of money next year. Can I buy some real estate and have these whopper write-offs, and I wouldn't pay, because my friend does that down the street, and she's and so forth. And I said, well, just get ready to visit your friend in jail, because that's what's going to happen. There's no magic in this. Buy real estate because it's a good idea to buy the real estate, not because of taxes.
Okay. Thank you for that, Scott. Yes, don't let the tax tail wag the dog, as they say.
Exactly.
Okay, folks, as I said when we started, this is a huge, complex area. But again, we want you to be alert about it, and also to be aware that these elections exist, so that if you do want to, you want to take advantage of it. Also, the record-keeping requirements means, again, keeping these diaries and so forth. Of course, when you're self-employed, the last thing you really want to do is keep a diary, because you were trying to get off a time clock.
Right.
Well, anyway, we hope we've given you some good things to think about. We'll see you next time on Financial Insider Weekly.